Hello, fellow Rebel Capitalists. Hope you are well. I wanted to do a quick explainer video on the risks with private credit. This is very topical right now. What's happening with Jefferies, what's happening with a lot of these private equity funds, what's happening with the regional banks, and how this is bleeding over into some of the bigger banks and even the European banks. And the way most people see the monetary system, or the way they think it works, leads them to underestimate the amount of risk that is actually in the banking system and actually in the monetary system. Because at the end of the day, the monetary system is simply a network of commercial bank balance sheets. That's it. And that's really the punchline. Let me explain. We're going to start with the average Joe right here. And most people see money or even currency as something tangible, something physical. So I've got some gold coins or I've got some green pieces of paper. So I'm going to take a bag of this cash and just go down to the bank and I'm going to give it to them. That's going to become an asset on their balance sheet, then go ahead and lend that out with fractional reserve lending and whatnot. And what they're going to give me is a receipt, an IOU, that I can trade in the real economy back and forth, and it's much more efficient. Let's just say a better medium of exchange. And in this case, in today's day and age, obviously that's going to be an electronic receipt, and that's in the form of a commercial bank deposit, but the key word there is deposit liability. This is how most people think the banking system works, and this is not how it works. Now, this might be applicable to, let's just say, 1%. And the reason I say that is because if we consider the entire global economy, it's about 120 trillion. And let's just say there's 75 trillion of quote unquote dollars out there. Okay, well, look at the currency in circulation. That's maybe 1-2 trillion, something like that. So let's just say there's $73 trillion out there that isn't in the form of a green piece of paper. It's nothing physical. It's just simply a commercial bank deposit liability. Now, how on earth does that happen? How is there 73 trillion of these, but let's just say 2 trillion of these? The math doesn't seem to work, does it? Here's the kicker. The way the monetary system really works is that the majority of the money, the 73 trillion, was lent into existence. So down here we've got Joe again, and for right now we're just dealing with this portion of the balance sheet, and then we're going to deal with this bank's balance sheet, this portion. Okay, so Joe goes to the bank and says, hey, I want to borrow some money to buy a car, and the bank lends him money, and then they make a deposit in his account. So let's just say it's $20,000 loan. That's the asset the bank just created, and a $20,000 deposit liability. Okay, this money was lent into existence. So there's no money at all. The only money that's involved here is a commercial bank deposit. What's the key word? Liability. There you go, liability. So then Joe takes that money, let's say he deposits it with another bank, and what happens interbank? How does this work? Well, this bank just transfer that deposit liability over here. Well, they have to give them an offsetting asset, right? So usually that's just in the form of another loan. You say, how on earth does that work, George? Well, it's a loan or an extension of credit from this bank back to this bank. So how the balance sheet changes is instead of this liability being a deposit for Joe, it's now a loan that this bank owes this bank. Oh, shoot, need my red pen here. So we'll just go ahead and put an L right here. That's how the balance sheets have changed. So let's just assume for a moment that Joe has a hard time paying them back. Or what could be a problem, let's say? Well, now we're going over here. Let's just say, did I say $20,000? Let's keep it simple. Let's just say it was $100. So a $100 loan, that's a $100 loan is the asset. That's the loan to Joe. And now their liability is $100 they owe this bank. And the asset is the loan or the extension of credit, $100 that this bank owes them, and their liability is the original deposit that was created by this bank lending the money into existence. In other words, creating a commercial bank deposit liability for $100. Okay, so Joe, let's say he has a hard time paying this back. Why would he have a hard time paying this back? Well, couple reasons here. Number one, let's assume that this $100 represents the entire money supply. And let's say Joe just deposits it over here and he doesn't spend it. So what we're showing is an example of no circulation of money, or very low circulation of money. In other words, velocity. Velocity is extremely low. So if he doesn't spend the money back into the economy, then he can't get the money back to go ahead and pay the bank to begin with. And we're just talking about principal. We're not talking about interest. Because remember, there's always more principal plus interest than there is money that exists. Because this $100 was created originally by lending it into existence, but there is interest on top of that, let's say $110. Now you can pay back $100 or $110 in debt with $100 as long as velocity is very quick. You see, you got to have that velocity. So that's one option there. The other option would be for Joe to go ahead and just borrow more money. So let's say he doesn't have the $100 to pay back. So he says to this bank, look, I just have to roll over the debt. So there either has to be velocity of the money or you just have to borrow more money. Those are your only two options. Now what happens if neither of those pans out? Well, then Joe doesn't pay this bank back. So what ends up happening there is their asset blows up. But now they don't have an asset, they don't have the $100 that they need to go ahead and pay the $100 to this bank that extended them the credit for them transferring over their deposit liability. So then this asset blows up as well. So now let's go ahead and erase this. And you can see where this starts to become a big, big problem. Now, let's move down to this line. I think we can go ahead and delete this here. I don't know. That's just overcomplicating things. So we move down to this line and we've got a deposit, that's an asset. So this is a cash deposit this bank has on its balance sheet, and then the offsetting liability is equity, their equity position. This is why they're not bust. This is why they're still solvent. But let's remember that this is not a bag of cash. This is going to be a commercial bank deposit liability. It's just going to be a liability of a different bank. And oh, by the way, it's probably going to be a liability of this bank. But wait a minute, this bank just had a hole blown in its balance sheet because this bank wasn't able to pay it back because Joe wasn't able to borrow more or didn't have that velocity of money that he needed. So then what happens is this bank goes bust. And if that bank goes bust, then what happens to this bank's deposit, their asset? Well, that goes away. And what happens to their equity? That goes away as well. Oh, but wait, there is more. Unfortunately, this is not where our story ends. Because what we're talking about is just two banks in this network, this monetary system. But we have to realize that there's thousands and thousands of banks, and every single one of their balance sheets, they're all interconnected to a certain degree. Now, not every single bank's balance sheet in the monetary system is connected to every other bank's balance sheet. But in a network, you can see how you have this chain reaction and this domino effect because so many of the balance sheets are connected. That's what makes the network to begin with. So if you have a couple banks going bust or really having problems, then their balance sheets are going to impact other banks because they're all part of that network, that may not go bust as a result, but what are they going to do as far as their appetite to lend? Because risk is going through the roof. You have perceived counterparty risk increasing, therefore the appetite for lending is going to do what? It's going to go straight down. That means a liquidity crisis. But wait a minute here. If Joe, or let's say Jeffries, or any of these shadow banks can't borrow any more money, then what do? And oh, by the way, if you get a liquidity crunch or a liquidity crisis, guess what's going to happen to the velocity of money? This is going to go straight down, and the velocity of money is also going to go straight down, which is going to make it harder for the other Joes out there to pay back the bank, and you have more banks going bust because of the interconnectivity of all of these balance sheets that make the network that is the global monetary system. And basically, that's what the dollar is at the end of the day. It's just a network of bank balance sheets that are just denominated in USD. So this is why Jamie Dimon says when there's one cockroach, there's usually a heck of a lot more. And this is why there is so much risk in this private credit in the shadow banking system. And when the tide goes out, that makes the tide go out even faster. It's like a doom loop because you have the velocity slow down, you have the borrowing slow down, you have a liquidity crunch, and that just exacerbates the original problem. So the key takeaway here is that when you're looking at the monetary system, in fact, when you're just looking at money or currency or whatever you want to call it, always remember that if you look at it this way, it's going to lead to confusion and bad decision making. So you have to look at money not as though it's coins or something physical, cash or anything like that. You have to look at it in terms of it being a commercial bank deposit liability, or more importantly, just a liability of a bank. That's all money is. That's all dollars are. At the end of the day, are liabilities of a banking system. And that banking system is completely dependent on velocity and additional borrowing. In other words, liquidity. And that liquidity is completely and almost entirely dependent on two things. One I haven't mentioned. Number one, it's risk. It's risk. If perceived counterparty risk is high, then I can assure you this liquidity is going to be extremely low. And the other thing, unfortunately, that it's dependent on is good collateral. And the only good collateral out there for dollar liabilities is simply going to be a dollar asset in the form of treasuries or government debt. So if you want the government to reduce the deficit, if you want the government to reduce the debt, what you're also saying is you want the government to reduce the amount of collateral in the monetary system. In other words, you want the government to reduce the amount of liquidity in the monetary system, which would likely lead to something like this. But we'll save that for a topic of a completely separate video.